Hey, what's up everyone? This is Due-Diligence here, and today let's talk about something that rarely people talk about. It's about market elasticity. What does it mean is essentially the market does not go up all the way to where it's supposed to be at and never go down to where it's supposed to be at. So during certainty, we will see a very smooth upward motion revolving from the true value line going up. And when we have a very uncertain market, the market will behave like volatile zigzags. And right now what we have is a triple uncertainty market. But what's really interesting is a lot of big players already placed their bottom super deep in the money call options, right? For example, if you look at Nancy Pelosi's portfolio with her husband, you will see that they marked Disney 130 as its lowest price would go in the next 3 years. And if you go and look at other players in the market, they all have their bottom out bets. But the thing is, they have millions of dollars to play with, which means their hedging money is probably the same amount of original position size, which means if you put $1 million in Disney options, you probably have another $1 million to hedge that. And a lot of time when you look at their portfolio, a lot of those positions are hedged with other multi-leg strategies, okay? And for those of you who think there's too much jargon in this video, I'm just going to simple it down for you guys, which means whatever they buy as stock or as options. For those of you who don't understand what option is, it's essentially a more riskier way of leveraging your upside and time to not really holding the stock for holding it, but have the rights to hold it or have the rights to sell it at a certain point. All right. Sorry about the glasses. I know my friend said it's really swag pink glasses, but really is. I had eye surgery last week, and I'm not supposed to even look at the sun yet, but I wanna post this video out. So what is the whole point of understanding market elasticity? Well, the whole point of this is if we know that we're right now in an uncertain period of time, why bother place daily or weekly bets if you can actually foresee what's going to happen monthly, right? Like, does that make sense? A lot of times the daily bets and weekly bets will really fuck around with your brain and really, like, for example, right, if you buy in Tesla at 885, right, couple of last week or the week before or whatever, when it dropped to that point, the second day it dropped again, right, and then it makes you uncertain and you will want to sell it, but right now it's $900. One of the things you have to understand is the whole trick of playing around and making money in the stock market is really having a long-term goal that you think the market or long-term target where the target is gonna hit in terms of like either the index, either specific stock, and use that as your anchoring point, right? Instead of placing endless daily bets and dream that you're gonna be a very successful day trader, the probability of anyone becoming a really successful day trader is in the 1%, or more like less than the 5%, right? But a lot of people have proven that they can be a pretty good medium and long-term investor as long as you don't place risky bets in all of these very interesting penny stocks, because the probability of penny stock have a consistent long-term return is actually the lowest among every single stock in the market. Like if you go backtrack and look at every big blue chip stock when it's like in the second in 2 digits and now it's in 3 digits, you will realize that a lot of times time is your friend. And in this case of the market, you have to figure out is what do you think in the next 6 months or a year that right now the stock has been beating down for so long, and maybe in 6 years or a month, not really a month, a year, it's gonna go up again. So what you need to learn or what you need to understand or research is 2 things. One is what is some undervalued industry that might benefit from the rate hike or might benefit from time being of the rate hike, right? And then 2 is you have to figure out what are some overvalued stocks that you hold right now that might not be as attractive later on. And 3, you should trim down on your very risky positions because the uncertainty calls for what? Risk trimming. And right now, and you guys are going, oh my God, the Fed's already hiked the rate. There's nothing gonna go even worse. Well, technically, the hiking 0.25% is within expectation, which means technically speaking, it's already been priced in 2 weeks ago, technically speaking. We have something that did a comprehensive calculation on that we use Python to do that. But in reality, what keeps dragging the market down is the Ukraine-Russia situation, the fear of Fed actually doubling its rate hike, and then the fear of Fed doing a consecutive rate hike. But the probability of we have another rate hike next month is actually pretty low. The reason being, Jerome Powell actually said that it's unreally likely, right? Unlikely. But in reality, the probability of happening is pretty low. Would it happen? Maybe. Who knows at this point, right? But we all know that the Fed is going to trim down its balance sheet. So what's going to happen over the next 2 months or so is you will have a bunch of people, right, start speculating what will happen when a massive amount of money is going to fly out of the money in thin air. So for those of you who don't understand why Fed have its own balance sheet, basically the Federal Reserve, when the market is really down or during a recession, they will use the reserve money to buy assets on the market. And therefore, it sort of started up the process of quantitative easing, which just means the government used government money to bail out different kind of businesses. And therefore, when we expect a sudden drop of market price, it will ease down and maybe recover a little bit. But what really happened over the past few years is the Fed quantitative easing method, or the effect of the Fed buying into the asset on the open market, actually have a tremendous effect on the short-term gain of the market. Therefore, later on in the long term, these short-term gain on the top of the chart is going to shrink. Therefore, for all of you who made a lot of money during 2020 and 2021 era, all of these margins are going to shrink to an extent all the way until when Fed trimmed down basically 50% of their asset on their balance sheet, which means 50% of these profit is going to evaporate by the end of when the easing down, when the cutting down, when the actual tapering process, which is actually trimming down their balance sheet, end. So what we need to understand is, or what we need to really think about is, when do you think that would happen? And in short term speaking, you will have a shock and it's gonna go up a little bit. But the thing is, the price is not gonna, the effect of trimming down their balance sheet is not gonna like suddenly realize, right? It's gonna realize over time. So we'll see more and more volatility along the way. And then what do we know about volatility? A lot of us gonna make money and a lot of us gonna lose money. So how do you deal with that? Place long-term bets instead of short-term bets. And then what else can you do? Hedge your position with VIX or something along that line to make sure that you have that safety line that you can fall through, right? Or you can hold on to. And third is to calculate your maximum downturn risk based on your assumption of where the market is gonna go. And after you watch this video, you will realize that, hey, maybe trading is not really my thing, but I can be an investor. What I mean by that is maybe trading daily is not really your job that you want to do. What you want to do is pick your best YouTuber that will give you the most information or informative content and listen to them either daily as a podcast or doing it in a weekly that you binge their video. And later on, what you will do along with their knowledge is you place long-term bets instead of short-term bets, because you're more likely to make money in the long-term bets instead of in the short-term bets, if you guys believe in statistics. Anyway, see you guys on the upside, and yeah, that's about it.